Now, the Institute of Economic Affairs, IEA, proposes a cash reserve ratio, CRR, of 5%, aiming to ease banks' obligations regarding liquid cash deposits. Previously, the CRR ranged from 15% to 25%, as announced by the Monetary Policy Committee, MPC, of the Bank of Ghana. Daniel Odrumensa elaborates on this in a report read by Fauzu Masawudu.
In the recent MPC meeting, the BOJ stated that banks with loan-to-deposit ratios above 55% must adhere to a 15% CRR. Moreover, those with ratios between 40% and 55% must maintain a 20% reserve, while banks below 40% must reserve 25% of deposits as liquid cash. However, Dr. John Kwache, the IEA's Director of Research, criticized the adjusted CRR rate as excessively high during a press briefing on reflections of the recent MPC meeting and the State of the Nation's address.
To turn around to mop the excess liquidity through very high interest rates, very high reserve requirements, and so on. That is the point I'm making. And they have increased it further, to 15 to 25. It's target, 25%. It's too much. And when you do that, you see, what you are saying is that if a bank collects deposits of 100 from the public, they should keep 25 in the central bank, which is not remunerated. The central bank doesn't pay any interest on it. I would even advise them to pay interest on it because it's a cost to the bank. And what do you expect the bank to do? It will go and raise its lending rate to the public to recoup that cost. So to me, it doesn't. I don't know. I can't support it. And what is reasonable? Maybe 5%. Nothing above 5%. We don't even need it.
On the other hand, the IEA accuses the Bank of Ghana of prioritizing budgetary concerns over the well-being of commercial banks through the use of monetary policy tools.
When banks take deposits from the public, you want them to deposit part of it at the reserve, at the central bank, as a precautionary, in case maybe they default in paying deposits, to the public. They can fall on what is with the Bank of Ghana. It serves a monetary control purpose also in the sense that because the banks are deprived of that much in terms of their deposits they take from the public, they have less deposits to be able to lend to the public. So it is as a monetary control instrument. We are using that as a monetary control instrument. We are also using very high policy rates as monetary control instruments. These are not the solutions to the problem.